success equals results minus expectations. And expectation setting is oftentimes an overlooked and important part of the founder and investor relationship. And so setting proper expectations around growth, around margin, around new products, around exit, around, what you're looking to kind of get out of the next year or 2 years, or making sure that overall your timelines and vision are aligned with your investors, right? Defining expectations and success, I think, can set you on the right path. And alternatively, if you don't do that, can really create a lot of misaligned incentives and negative situations.
Hey everyone, I'm Hannah Dittman, Operations and Finance host of the Startup CPG Podcast, and today I'm thrilled to be joined by Trevor Rechnitz, principal at Vanterra Ventures. Trevor brings deep consumer investing experience built over nearly a decade, from sourcing and diligence to partner engagement and post-close value creation. He's got a wealth of knowledge in company evaluation and executional strategy. At Vanterra, he helps evaluate and back visionary teams and companies redefining consumer health, digital health, and enabling technologies across branded products and emerging categories. Vanterra Ventures is the venture and growth equity arm of Vanterra Capital, partnering with founders to build long-term disruptive businesses in the consumer health ecosystem. In this episode, we dive into honest, practical conversations about the realities of fundraising, not just what looks good on paper, but what truly matters to investors. Trevor breaks down common pitfalls founders encounter and shares lessons from diligence processes, how investors and founders think about capital allocation, and what metrics actually signal durable growth. We talk through LTV to CAC dynamics, how to build investment thesis that resonates with investors, and how to align fundraising strategy with operational execution. If you want to level up your understanding and investor thinking and set your fundraising and growth strategy up with intention, this episode is for you. Enjoy! Hey everybody, welcome back to the Startup CPG Podcast. This is Hannah, and today I am here with Trevor Rechnitz, an investor from Vanterra Ventures. Trevor, welcome to the show.
Thank you, Hannah. Happy to be here.
We're so excited to have you today. I'd love to kick off with getting your formal brief background, what your career has been like to date, and the path that led you to Vanterra.
Yeah, absolutely. I'll try to keep it brief. I grew up in the Bay Area. I did my undergrad at Northwestern, studied communications and economics. I spent a few years after graduating back in San Francisco doing what's called private equity consulting at a firm called Kurtis Salmon, which was a CPG-focused consulting firm. I was on the private equity and strategy team there. So we were doing commercial due diligence on behalf of larger private equity funds as they were looking to invest in the CPG space. So tackling work like market sizing, consumer surveys, expert interviews, revenue growth modeling, in all sorts of different categories across CPG, food and beverage, supplements, etc. Ultimately, I moved from Kurtis Salmon over to the buy side and started my career in VC at a fund called Circle Up Growth Partners. That was in the fall of 2018. Had an amazing time there. Kind of grew up as an investor there alongside some incredible investors, Kiva Dickinson, Allison Ryu, Ryan Callbeck. And I actually had looked at a few deals alongside the Vanterra team while I was at Circle Up. And candidly was just impressed by the process, impressed by the team, the portfolio. And when they were hiring for a VP to help institutionalize their venture platform, it was a natural fit. Life was also kind of taking me to New York at the time. So I moved out here to New York in spring of 2021 and started at Vanterra.
Amazing background. You've got a deep foot into the diligence space and have, I'm sure, spent a lot of time with a lot of different companies throughout that journey.
Indeed.
I'd love to also get a firm overview of Vanterra, including, criteria, mandate, differentiation, check size, stage focus, and also kind of where you sit on the VC to growth to PE spectrum.
Yes, yeah, for sure. So we are a venture and growth equity fund. We're investing in the future of consumer health. It's a $6 trillion category. It's growing 10% year over year. It's massive space. So to kind of distill it down, we've split consumer health into three core categories: products, services, and tech is what we're calling them. In products, we focus on categories like supplements, functional food and beverage, pet health, beauty and personal care, amongst others. In services, some examples: digital healthcare, health diagnostics, personalized medicine, even some asset-light four-wall services businesses. And then in the technology category, categories like picks and shovels, kind of enablement technology, and some healthcare infrastructure as well. So relatively broad set of business models and categories all under consumer health. From a stage standpoint, we write our initial checks into seed and Series A rounds. We for follow-on checks, we can go a little bit later than that into kind of more growthy Series B, Series C rounds. Check sizes for us range from 1 to 10 million, with the ability to upsize through LP co-invest as well. And yeah, we closed our second fund in Q1 of last year. It's a $100 million fund, that puts our total AUM at about 175 million. And then from a differentiation standpoint, I'll mention a few different things. The first thing is being a sector specialist. So we spend all of our time in consumer health. We feel like that allows us to drive differentiated deal flow, to compound knowledge over time, ask the founders the right questions, kind of dig into key risks of these deals relatively quickly, and then also to build in-depth capabilities to add value after investing, right? So the more time you spend in a particular category, the better you get at helping founders in that particular category. The second piece is being concentrated and taking a high conviction approach to venture. We'll likely have about 15 or so companies per fund. That's a bit smaller than traditional VC. So we're doing deep work on each of these companies before we invest. Kind of the opposite of a spray and pray venture mentality, right? More of a private equity approach to venture, where we have a rigorous due diligence process. We're rolling up our sleeves after we invest, targeting capital efficiency and profitability in these businesses. The last part of your question, not to ramble here, but the where we sit in like VC and growth, that makes sense to chat about.
Yeah, that's super. I know you kind of are flirting with touching on it already, but give it to me.
Yeah. So I'll kind of split the market into 4 buckets. The way we think about it. The first is kind of angel and pre-seed, right? Which is initial founder rounds. There's product risk, there's tech risk, there's business model risk. A lot is unproven. From an investment standpoint, that sort of demands that you're taking a lot of swings, and it's candidly a higher failure rate, and it's a bit too early for us. So we avoid those rounds. The second bucket is venture, and that's seed and Series A. The risk kind of shifts to more scaling and execution risk. There's still opportunity for big returns. But the businesses are kind of at an inflection point, right? Like have proven out DTC, but going into retail as an example. And this is really where we're comfortable, where the bulk of the dollars from our fund will be deployed. The third is growth, kind of Series B and C rounds. We'll look at these rounds from a follow-on or co-investment standpoint, but less so from an initial round standpoint. And then the fourth is, later stage VC, which is a bit beyond our purview, lower return profile, higher valuations. It's a bit too late for us.
Beautiful breakdown and very crisply stated. I can see the old consultant in you.
Yeah, a lot of buckets, a lot of frameworks. Yeah.
These are the 3 things I'm going to tell you.
Yeah.
Very helpful. Great way to explain it. One thing you mentioned earlier on in your intro that I just wanted to double click and kind of give an explanation of is you mentioned that you could write follow on or lean into bigger checks with LP co-invest. Could you explain what that means for anyone that may be unfamiliar with it?
Yeah, absolutely. So as a venture fund, we obviously have LPs. Those are the investors that make up the majority of our fund, right? Those LPs obviously trust us to invest capital, but also like to scale up their own additional investment into certain portfolio companies that they have conviction in, or that they are particularly passionate about. So typically how it works is we'll invest relatively early in these businesses. As those businesses de-risk and become profitable over time and are a bit closer to liquidity or an outcome, and raising bigger rounds, we'll invite our LPs to invest alongside us. So as an example, in a business called MixLab, which is a tech-enabled pet pharmacy, it's our biggest position in our second fund. We've invested a decent amount out of the fund, but have invested almost double that in LP co-invest. And so it's a benefit to our LPs to get access to these types of deals, and obviously a benefit to us as well to be able to kind of scale up our position.
For companies that might get an LP co-invest check, is their experience as a portfolio company any different from any of your other portfolio companies?
No. All of our kind of checks we're writing with the intent to like spend meaningful amount of time with each company. Obviously, as time goes and as positions kind of either grow or don't grow, obviously time allocation shifts. So typically the ones that get LP co-invest are the ones we're spending the most time with. But I wouldn't say treatment's any different.
Super helpful. Thank you for clicking on that with me. Can you touch on maybe common mistakes founders make in fundraising or diligence processes as they go through it with you? Maybe like a diligence process overview and the key things that you think people should anchor on or focus on, that maybe people don't always get right or fully understand.
Yes, yeah, for sure. So I guess it probably makes sense to just start with like an overview of the diligence process, and then I can go through like what our expectations are, and from there, like what some do well and what some don't. The diligence overview for Vanterra, so it takes about 3 weeks, combination of data requests and management team time that ultimately we're using to try to get comfortable with the key risks that we've identified and ultimately determine what the right valuation for the company is. That diligence process typically starts with a first meeting, right? In those first meetings, my hope is that the founder is able to articulate the problem being solved and what makes the solution unique and more compelling than other incumbent and emerging solutions. Broadly speaking, like differentiation in a way that matters to consumers is a signal of enduring value. And so being able to communicate that on an intro call is massively important. In addition to being able to communicate the broader vision for the business, near-term and long-term growth levers, et cetera. I would say like mistakes that founders make, especially on the intro call, and intro calls sort of set the tone for, the broader diligence process, whether the investment team internally is excited about continuing the process, et cetera. There's a couple. One is like getting defensive about risks almost, as opposed to attacking risks head on. So don't be shy about the risks. Like VCs are, hopefully, if they're smart, are going to identify them anyways. So being honest and open about them, sometimes saying, I don't know, this is something we're, actively thinking through, like invite the investor in as a partner, and don't be shy about the risks of your business, like, kind of attack them head on and have the honest conversation. The second is, make sure you know your numbers cold. Like there are certain numbers that investors are going to want to know. I think over time, as you like pitch a bunch of them, you'll figure out what those are. But things like channel mix or AOV and LTV to CAC or retention, obviously revenue, gross margin, burn, et cetera, over the last few months and how they've trended over the last few years, et cetera. You need to know those cold, and you need to understand how those like fit the broader narrative that you're trying to discuss. I think like certainly it's a yellow, if not a red flag, if I'm on a call and someone's a bit shaky on their numbers. So that's another one. I would say that the third is, make sure that you're also like spending a bit of time interviewing the VC too. I love when founders are asking questions that, make it very clear that they're looking for a partner, asking about your background, asking about how you would add value, what your initial perspective on the opportunity is. Again, like turn it into a little bit more of a conversation versus just like a, full kind of like deck walkthrough.
That's really helpful. And kind of on the flip side, what gets you really excited about an intro call? Like, it's 30 minutes essentially where someone's kind of giving you the quick high level overview of themselves and their company. What's like an A+ version of that?
Yeah, it's hard to like really put your finger on. Like a lot of A+ look different than one another, but like one thing they typically all have in common is it's just a really strong articulation of the problem and solution and why that founder is the right one, and maybe only one who is in position to solve the problem. That's sort of like the most compelling start to like all of the the A+ pitches is like, there's a massive problem, here's my solution, like here's kind of the founder market fit or the reason why like I'm the right person, and the solution I've created is the right solution to solve that problem. So I think keep like communicating that, keeping that very tight, is a really, really good way to start your pitch. The second thing I would say is do your homework. Like a lot of founders are, and so when someone shows up and like knows about our fund, knows about our portfolio, knows some of the questions to ask, like understands what we look for to a degree, like why they might make sense in our portfolio, et cetera, like that goes a long way, I think, on these intro calls, and other people are doing it. So I would certainly try to do that as well. And then the third is a bit more tactical, but the right like cadence of information sharing is actually really important and helps you stand out as well. So sharing a deck and a blurb beforehand, following up after, having a data room put together, et cetera. Just like being there with the right information at the right time goes a long way too.
Could you give an example of a portfolio company that you all work with that you feel like had a really great example, answer, or thesis behind the problem, solution, founder fit that you're describing?
Yeah. Chad Janis, who's the founder of Grooms, had a really impressive initial pitch. Basically that, he grew up and his grandma would make him like, green smoothies. But those smoothies are difficult to make. And sometimes didn't have like an amazing taste, but he wanted kind of the same, like, whole fruits and veggies and vitamins, that he would get from those shakes, but in a convenient format. And so, created Grooms, obviously comprehensive daily nutrition gummies. And from a background standpoint, he was a former investor, at a fund called Summit Partners. And so had unique insight into a lot of, these high growth CPG businesses and how they were built just from a fundamental standpoint. And so, unique problem, like, unique solution to a big problem, and really, really, kind of special background and perfect background to, on why he's the right person to solve it.
Yeah, I think that's really helpful color for other founders to understand how to kind of position their background. It's not like you're looking for someone necessarily. I mean, I'm sure it would be a great bonus for someone who's like 15 years exactly in the power lane of exactly what they've done before and doing this. But it can be a lot of different backgrounds that seem impressive as long as it makes sense and shows a lot of rigor and hustle, it sounds like, an ability to see a vision and execute diligently behind that vision on the founder side.
Yeah, it's so true. Like from a founder framework standpoint, like obviously domain operating expertise and experience is a criteria that is great to have. And we certainly use that in our framework. But like what we care more about is, are you high horsepower? Are you a good capital allocator? Have you shown or do we believe in your ability to hire and retain top talent? Do you have passion and personal experience that's like associated with this product or idea? Do you have a partnership mindset like I was talking about before? Are you responsive to diligence requests? And maybe most importantly, like, do we believe that you're a quick learner and you're a fast operator? And if there's a problem that you're going to be able to understand and adapt to it. So yeah, obviously like having a direct background in these things is great, but it's certainly not necessary.
Yeah, and going back to your earlier point when you mentioned, the first meeting you want to invite the investor and be realistic about the risks. I'm sure also like have some sort of mitigation plan for them. But it sounds like that's kind of dovetailing off of this same comment that you just made, where it's, someone collaborative who's risk on, but also learning, growing, and ambitious to develop their own perspective as well.
Yeah, for sure. And yeah, I think there's a ton of value in any job of just like knowing what you don't know, kind of approaching things with like an open mind that there's probably people out there that are much, much better at solving that particular problem than you might be. And sometimes the best skill is to like convince them to come work alongside you, right? And I think that's another area where Chad's just totally spiked, is team building, selling the vision, like building a winning culture. And being able to just attract the best, right? And now he's just got an incredible team around him.
Super helpful. And thank you for the examples. You've worked with all these founders, you've worked with a lot of businesses in your portfolio and over time. If you could tell founders or operators one piece of advice, maybe some key learnings from where you've seen companies go down the road, right or wrong, or just in general, what would it be? And why do you think it's important?
Yeah, I'll give two because of course.
Bonus.
One kind of higher level and one tactical. So the higher level one, and it's like a framework that I use in my job and life all the time, is that like success equals results minus expectations. And expectation setting is oftentimes an overlooked and important part of the like founder and investor relationship. And so setting proper expectations around growth, around margin, around new products, around exit, around, what you're looking to kind of get out of the next year or 2 years, or like making sure that, overall your timelines and vision are aligned with your investors, right? Like defining expectations and success, I think, can set you on the right path, and alternatively, if you don't do that, can really like create a lot of misaligned incentives and negative situations. So I would say that's my higher level one that I want to get across. And the second one is very tactful, and shout out to Ben Zeises, who turned me on to this one, but I think it's very true, is to send consistent investor updates. It holds you accountable, and it's honestly, it's such a scalable form of communication with investors, of one-to-many communication, that in terms of ROI on time, it just is kind of a no-brainer. And I think it's one of, if not, it's one of the most correlated variables to success that I see. One of the things that a lot of the home run businesses in our portfolio have in common is that from an early stage, they've sent consistent investor updates.
That's really helpful. What should an investor update consist of for you? Or, what are the typical formats of ones you see in terms of length, content? Is it monthly? Is there a lot of business changes between investor updates? Could you give a little bit more color and guidance on that for any founder that wants to get started or develop that a little further?
Yeah. And for anyone that's interested, I'm happy to send templates too, but there's no one size fits all, honestly. It's always different. Generally, they like all include some kind of high level metrics, right? Like, how did the month go? And usually monthly is the right cadence, honestly. How did the month go from a top line standpoint? How did it go from a margin, bottom line standpoint? Like, what are kind of the top 3 or 4 KPIs that your business is tracking? Is it repeat purchase? Is it Amazon reviews? Is it like whatever those are that you've established with your investor base and board, to kind of give a high level update on those. And then, just kind of key, like, hey, like what's gone well, what hasn't, and like, what do I need help on, right? Like, that's generally like what's in every single one is, hey, here are my asks. If anyone knows a buyer at Costco, or if anyone knows like the best, SEO agency or whatever it might be, again, like one to many of putting those asks out there is I think, a really scalable way to spend your time.
Yeah, that's really helpful. And I feel like sometimes I think people can be a little shy about making asks because you're not sure, like, is this supposed to be like buttoned up where everything I'm saying is amazing? Or is this supposed to be more realistic where I'm just having like an honest update about my business and I can be vulnerable? And I think a lot of founders kind of grapple with that or in general can be anxious about fully disclosing some aspects of their business or, talking extensively about what they're worried about or what they're working on for fear of being judged if they're trying to get a fundraise done. So I think it's really helpful perspective and color to see how you're thinking about it and what you're receptive to, and that questions are good, and identifying risks might also be a positive for a founder to do as well, because it shows they're thinking about things in a critical way.
Yeah, I agree. I mean, I might bias towards honesty, maybe a little bit more than is helpful. But again, like one takeaway is just like, and this is actually a decent signal for founders as they're going through an investment process, is like, you should gravitate towards the investors who are willing to have the hard conversations. You should gravitate towards the ones who are like open to, like hearing and understanding what's not going right with the business. I think generally speaking, like our median hold time is 5 years, can be as long as 10 years, right? So like to think that there won't be really difficult times is just kind of a joke, right? And oftentimes when you're fundraising, things are going well, and when you're closing around, everyone's happy. But hopefully, like throughout the investment process, there's a hard conversation or two to have around valuation or around risks or whatever that is. So you at least can get a sense. So I don't know. Speaking personally, I love it when founders are kind of mentioning things that are not going well in their investor updates, so that I have an honest view. And it's kind of like, if everything's rosy, my feelers are up of like, what are you hiding? Like, what's in there for me to find versus getting
That's that diligence muscle coming out.
it's true.
Seeking for the gremlins and truth finding. I think that that's great advice and touches on, I think, how important, to your earlier points as well, how important it is to find the right fit have the same expectations in your business, not from just a numerical standpoint and a performance standpoint, but also from a relationship dynamic and experiential standpoint as well. So, yeah, I think that's great commentary and great color. Um, in terms of lessons learned outside of just advice to operators or founders, when you reflect on your investing career, have you learned any lessons or compelling anecdotes in terms of maybe like more external factors like market shifts or trends or, you know, product launches or anything kind of more high level that you feel like you kind of wish you knew at the beginning or that might be helpful for others to learn from, um, in terms of like as they're thinking about embarking maybe on a new company venture and becoming a founder or are kind of earlier in the days of building out a product, how they should think about certain things?
I mean, I don't want to say this and like discourage a whole swath of founders in particular categories. I'm probably not saying things that they don't already know, but I would say that like high gross margin is essential and is like the silver bullet alongside repeat purchase rate to like surviving as a consumer, as a CPG company. And there are particular categories, obviously, personal care and beauty and supplements probably being the top two that typically come with software-esque scalable gross margins. And there are certain categories, beverage and frozen, that like usually don't. And it just puts so much more pressure on the other parts of your business to have that like incredible product, incredible velocities, incredible repeat purchase rates, like to like have basically an incredible capital allocation and ability to project forward to make sure that you're like allocating, managing cash appropriately, right? Like so much less room for error in some of these categories. So I would say, at least as if you look at our portfolio, it's kind of like you can see where the dollars have flowed. From a category standpoint, a lot of that has to do with margin. So I say that, and if I were to start a business, I would start a business in one of those categories. Like that's typically what and makes it easiest for us to get there from an investment standpoint.
What are high gross margins to you, and what is a compelling repeat purchase rate from metric standpoints?
Yeah. From a gross margin standpoint, and everyone defines gross margin a little bit differently. Like I typically look at it, after basically all non-marketing variable costs. So, including kind of freight and shipping, et cetera. Good, like, is north of 60, great's north of 70. And from a repeat purchase standpoint, it's a little harder to just look at that metric in isolation because like it's harder to get someone to repeat purchase something that's $100 versus $40. And so you kind of have to look at it through the lens of like an LTV to CAC type metric, because that tends to capture it captures a lot, but it adjusts for a lot of those things like around price point basically. So I would say like typically we're looking at like 3x plus LTV to CAC over 2 years or sometimes 3 years, depending on the category.
Could you break that down in layman's terms for me? So when you're saying 3x LTV to CAC over 2 years or so, what specifically, if I know nothing about this, what specifically are you telling me?
Yeah, it's a great question. So LTV to CAC stands, LTV is lifetime value, CAC is customer acquisition cost. So it's a fraction, right? So LTV divided by CAC. So we start with LTV. LTV, it breaks down to a couple of different components. One is AOV, right, which is average order value, or how much money someone's spending on your product. Multiply that by your margin that we just talked about, your gross margin, and then multiply that by let's say you're taking a 1 year LTV to CAC, right? So in this particular time frame, how many purchases does someone make in a year? So like dollars spent on one purchase, margin percentage times number of purchases in that particular time frame. Collectively, that's going to give you the LTV within whatever time bound that you just set. you're going to take that number and then divide that by CAC, which is customer acquisition costs. Customer acquisition costs is total marketing spend divided by total new customers acquired. And effectively, like when you look at that metric, LTV to CAC, it's telling you like how profitable is each particular customer to my business in that particular time frame. And so, if we're saying 3x LTV to CAC, we're saying every new customer that you acquire within this particular time frame is going to be worth 3 times as many dollars from a gross margin standpoint as it costs you to acquire that customer. The reason why we care about it is because it's a metric that helps predict long-term profitability of businesses. So the higher the LTV to CAC, the more profitable your business can be over time. And as investors, that's important to us.
Super helpful and concise breakdown. Thank you so much for that. If a founder, you're mentioning, like 60% gross margins, 3x LTV to CAC, if a founder is falling short on any of these metrics, how concerned should they be, or how should they approach that in fundraising or in business management? Sometimes it might make sense, like you're saying, based on the category or structure of their business, but when should they be concerned, and when is it prohibitive to fundraising?
Yeah. The first thing I would say is like being concerned about LTV to CAC is hard because you need to break it down in order to truly diagnose what to be concerned about, right? So if you take the components that I just laid out of LTV, like, do you have a margin problem? Do you have, an AOV problem? Or do you have, a repeat purchase problem? If you have an AOV problem, like consider going up market. Like why, understanding the question of like, why are consumers not willing to pay more for my product versus competition? Do I need to add more premium features? Do I need, like, can I charge more for my product, et cetera? Do I need to bundle it with other products on my website, et cetera? Do you have a margin problem? Like, is that margin going to get better as I scale? Can I sell that story to investors? Like, do I need to find a new co-manufacturer? Do I need to vertically integrate, et cetera? Or like, do I have a repeat purchase problem? I would say repeat purchase problem is probably the one that I would be most concerned about. It means that like your value prop or your product doesn't solve a meaningful problem for consumers. And that's a really difficult problem to fix. It's a really hard problem to convince investors that we're going to fix. So the first two may be solvable, the last one potentially not solvable. And then from a customer acquisition standpoint, like, it's like, okay, I have a $50 product. It's costing me $100 to acquire a customer. Like, yikes, right? Maybe there's room to, change how you're spending on channel spend allocation, like spend more on Facebook versus on YouTube. Maybe there's room to change your, your content to attack like the top of the funnel, et cetera, et cetera. So I hesitate to throw a number on it to say like, if it's lower than this, don't even try fundraising. I would say like, break it down, figure out which problems are solvable versus not. And then be honest with yourself. If they're not solvable, then maybe it's not right to raise.
Yeah, and I think that's really helpful color. And it kind of goes back to the earlier point you made as well, where, during that initial pitch, it's the problem solution, but also the kind of narrative of your business. And I think understanding the context of these metrics for yourself and the story of why they are the way they are and how you're going to get to where you need to go with them, I think is an important part of the fundraising process and what investors are obviously thinking about themselves, and also looking for leadership from you on to make sure that, again, you're aligned, but also that you're selling them the vision, not just in terms of why the vitamin gummy is so great, but also why the business can get so great from an operational standpoint as well.
Yeah, no, I think that's a good articulation. Yeah, I think like every investor is trying to answer the question of like, what do we need to believe, right? Like what do we need to underwrite for this to be a successful investment for us, right? And so are we underwriting improvement in gross margin? Are we underwriting a decrease in CAC? Are we underwriting, your ability to increase AOV over time, right? Like, or are the metrics just so good that we're just underwriting your ability to kind of continue, or even that there might be some degradation over time and that's okay for the investment case? And so all of those questions are what's going through investors' heads in investment committee discussions. And, those are all conversations that like get baked into valuation too, right? So the easier that you make it and kind of the more clear narrative that you can paint around like, hey, like here are the components of my LTV to CAC as an example. Like, here's kind of the, the ways I'm going to improve XYZ. Here's what you need to believe. Here's, why you should feel comfortable underwriting these different things. Like, it's just going to make your life a lot easier to get a fundraise done and to get it done at a good valuation.
So well said. And a great articulation of a lot of these things and the other side of the table, as well. Are there any companies that you've invested in that had perfect scores essentially across all of these metrics, or is it pretty commonplace that there's always kind of something that might be a little bit of the risk area in a business, and that's something that you are comfortable with going into an investment as long as there's a strategy around it?
Yeah, no business is perfect when we look at it. Like, hindsight's 2020, obviously, right? So you want to say that the ones that are ripping right now, like when we looked, like our framework was perfect and it checked every box, but that's just not true. So it's about like checking enough boxes and being compelling enough of a check, I should say, of like, spiking on particular areas that fund cares about, right? So, if you're spiking on product differentiation, and on a repeat purchase and on capital efficiency, like for us internally, like, we're gonna love that. So it is about just checking enough boxes and being really strong at particular things that certain frameworks or processes care about.
Well said. Thank you. I'd love to pivot into a Slack question. As you know, Startup CPG has the largest Slack community in the industry with now over 30,000 members. I'd love to pull a question directly from our channel and have you answer it as a case study for any founder that might have a similar question. Today's question is, what revenue size equates to each fundraising round?
Great. I'm going to give you the non-answer answer, then I'm going to just give you an answer. The non-answer answer is like, these rounds have all been stretched and put into gray areas to a degree where it's difficult to put revenue ranges on them. Not only that, but like, investors are looking at much more than just revenue and generally looking at like other signals of product market fit to gauge whether you're ready for a Series A versus a seed. Something like, do you have success in your ultimate scalable channel? Like, if you have DTC, Amazon, and your, best-in-class target velocities, you're potentially ready for a Series A, even if you're at $4 million in revenue, right? Versus, a business that might be $15 million in revenue, but just on DTC, it might not be ready for a Series A because it's really difficult to underwrite, that business getting really, really big and ultimately selling without traction in retail or in Amazon. So that's the non-answer, is that it's really difficult to say. For the answer, I would say like 0 million pre-seed angel, 1 to 5 million seed, 5 to 15 Series A, 15 to 30 plus Series B.
Thank you so much. I love the complimentary answers, and I think the context is really helpful, but the brass tacks, I feel like, helps founders orient quickly, and I think that is a great way to break that down. Well, this has been such a fun chat, Trevor. You are such a wealth of knowledge, and I feel like you have so much tactical, great guidance and advice. It's been awesome to learn from you. For founders that want to get in touch with you, where can they find you, or what's the best way to get in contact? And then second question, for operators or others looking to transition into investing, what advice would you have for them to break in?
Yeah, to contact us, we have an email on our website. Feel free to email a deck or find me on LinkedIn and introduce yourself. Generally pretty responsive. For non-investor operators trying to break into VC, yeah, that's a tough one. I would say pick a lane. So like, in this case, likely CPG or wherever you are, like become a specialist in something. Like, that's probably your way in versus like being a generalist. And 2, I would say publish your thoughts, come with a point of view. So investors love when people interviewing for the job are already kind of doing the job, meaning like they come to an interview and say, hey, here's an investment thesis I put together. Here's, my map of the women's health market and why I think like fertility and menopause are really interesting places to play. Here are the business models that I think work best there. Health services in hormonal health and fertility, but supplementation and menopause for XYZ reasons. Here are a few different companies that you should look at. I've actually met this founder who you might want to talk to. She's actively raising. It's like, okay, it's hard to argue with that. And I think like in order to break into investing, you kind of have to be hard to argue with. So that's the advice.
Great advice. And yeah, you're so sharp and have so much nuggets of information. This is a awesome chat and a great way, I think, for founders to get a peek not only into some tactical advice, but also into how you think and how you process things on the investor side, which I feel like is sometimes opaque and really helpful to understand. So thank you so much again for your time, Trevor. It was so great to have you here.
Thanks so much, Hannah.
Thanks so much for tuning in, everyone. If you like this episode, show us some love with a 5-star review at ratethispodcast.com/startupcpg. I'm Hannah Dittman, podcast host and correspondent here at Startup CPG. I hope you'll join me again as we dig into more juicy topics like ops, finance, and all the real talk founders actually need. Come say hi on LinkedIn or ping me on Slack. I'm always eager to hear your questions or brainstorm future episode ideas. If you're a potential sponsor and want to get in on the fun and appear on the podcast, shoot us an email at partnerships@startupcpg.com. And last but not least, if you haven't already, don't miss out on our free Slack community for emerging brands and CPG lovers alike. Join us at startupcpg.com. We'd love to have you. See you next time.